Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers on this Thursday, December 11th, 2025.
That's right, Ethan. We've got a lot to unpack today, from yesterday's market discussions and our AI's latest insights.
Our analysis today cast a pretty wide net, Brooke. We saw a significant volume of social media posts flagging quite a few different stocks. The overall market sentiment feels really dynamic, a mix of cautious optimism and some deep skepticism, especially around certain valuations.
Indeed, there's plenty of buzz, but the underlying numbers tell a story that isn't always as rosy as the community chatter. It's a day where risk management needs to be front and center.
All right, let's dive into the first one on our list, NVIDIA, or NVDA. Now, the community discussion around NVDA today was, shall we say, lively. There's a strong undercurrent of optimism, with some users really bullish, pointing to its dominance in AI and continued growth. Some folks are still saying it's wildly undervalued, especially given its recent earnings strength and market position.
Lively is one word for it, Ethan. I'd say heated debate is more accurate. While I respect the growth story, the AI analysis highlighted a significant portion of comments questioning NVDA's valuation, especially that PE ratio. We're talking about a PE of 45.49 here, which is much higher than what some users were even misquoting. That's a hefty premium that implies extraordinary future growth, and the community is picking apart how sustainable that really is amidst increasing competition.
But the revenue growth and net profit margins are incredibly robust. Those are foundational to a growth stock like NVDA, justifying a higher multiple for many investors. And the news about its H200 chips going to China, that's a positive for revenue, right?
It could be, but the insider selling is a major red flag for me. Over 5.5 million net shares sold in the last 6 months. Insiders are taking profits. Plus, the debt-to-equity ratio at over 9 is something to monitor. Previously, we've had a mixed bag on NVDA, with our last rating on December 4th being stay away. Given the highly divided sentiment, the high PE, and insider selling, I don't see anything to change that.
Okay, I hear your points, Brooke. For NVDA today, I think we have to align with the cautious view.
My AI-generated insights lean toward caution too. So the final verdict for NVDA? Stay away.
Next up, Carvana, CVNA. This one has been on an absolute tear recently, with social media buzzing about its incredible winning streak and upcoming S&P 500 inclusion. People are seeing massive gains, and that momentum is a powerful force, suggesting it's not done yet.
Ethan, the momentum is undeniable, yes, but the numbers? Oh, the numbers. Our AI analysis shows an absurd valuation, as many users put it. We're looking at a PE of over 106, a price to book nearing 29, and a debt-to-equity ratio of 192.41. These KPIs are screaming overextended. And just like NVDA, we've seen significant insider selling, over 32% net share sold in the last 6 months. The S&P inclusion is a temporary catalyst, not a fundamental change in these underlying metrics. We've rated CVNA as a stay away multiple times recently, including December 6th, and frankly, nothing here changes my mind.
Well, I suppose a winning streak doesn't mean it's fundamentally sound forever.
Exactly. For CVNA, despite the headlines, the fundamentals are too concerning. The final verdict for CVNA? Stay away.
Let's turn to Ubiquity, UI. Interestingly, the social media chatter we picked up today wasn't about the company itself, but rather a UI bug on a completely different platform, which is a bit of a curveball. But looking at the actual company, we've seen a strong year-to-date share price rally, and their Q1 earnings surpassed estimates with a top-line surge. That kind of growth and market momentum can be very attractive.
It is, but let's separate the stock from the noise. While the revenue growth is positive and the company shows strong profitability in metrics like net profit margin and return on equity, the valuation is quite high. Their PE is 44.63 and price to book is over 42. More critically, the debt-to-equity ratio is an alarming 21.508. That's a lot of leverage for a company, especially when there are external reports questioning underlying issues with the quality of Ubiquity's earnings. We've never rated UI before, but these financial red flags are hard to ignore.
So even with the strong rally in earnings, the risk is too high for you?
Absolutely. The high debt and questions about earnings quality combined with an already premium valuation make it too risky for new positions right now. The final verdict for UI? Stay away.
Moving on to Weibo, WBO. Again, the social media discussions were mistakenly about Netflix and Warner Bros. Discovery, not Weibo itself. But when we look at Weibo, we see some classic deep value indicators, a very low PE of 5.85, a price to book below 1, and an appealing 8.01% dividend yield. They're also talking about navigating revenue challenges with AI, which could be a strategic pivot.
Ethan, those are indeed classic value indicators, but they can also be warning signs of a value trap. The AI analysis points to some very serious concerns. Negative revenue growth of minus 0.048, meaning their business is actually shrinking, and the debt-to-equity ratio is an absolutely astronomical 47.283. A high dividend in a shrinking, highly indebted company in a challenging industry facing regulatory headlines in China, that dividend might not be sustainable, and the low PE could just reflect market skepticism about its future. We've never covered WBO, but these are too many red flags.
A shrinking business and that much debt, I can see how that overshadows those value metrics. Definitely. The final verdict for WBO? Stay away. Now, Netflix, NFLX. This is where the YOLO crowd is out in full force. The sentiment is speculatively bullish, with many users seeing the recent dip as a fantastic buying opportunity. There's a lot of chatter about the massive Warner Bros. Discovery deal, with people betting on either the acquisition succeeding or even failing as a positive catalyst. That's some exciting high-risk, high-reward play.
It's certainly a high-stakes gamble, Ethan. But let's look at the numbers. Despite the dip, NFLX still has a high PE of 38.79. That's not exactly cheap, and the beta at 1.706 confirms its extreme volatility. The biggest elephant in the room is that reported $82.7 billion bid for WBD. While their current debt-to-equity of 65.822 is manageable, a deal of that magnitude would drastically increase their financial leverage and bring immense integration risks. The stock has been underperforming even as the broader market gains, which highlights that caution is warranted. Our last rating for NFLX was stay away on December 9th. So even with all that speculative optimism, you're not swayed? Not when the stakes are that high, and the valuation still implies perfection. The potential for that WBD deal to either make or break the stock is too great a variable. The final verdict for NFLX, stay away.
Speaking of Warner Bros. Discovery, WBD, the sentiment here is predominantly bullish, directly fueled by the anticipation of a bidding war. Users are literally saying, I don't care who wins, I just want them to keep bidding. The stock is trading near its 52-week high, and the news is just non-stop with Paramount, Skydance, and even political figures like Donald Trump weighing in. It's a very exciting time for WBD shareholders.
It sounds exciting, Ethan, but the KPIs tell a very different story when you strip away the acquisition buzz. WBD has an astronomically high PE of 155.42. That means its current price has absolutely no grounding in its current earnings. Its debt to equity is a very high 89.857, and its net profit margin is a meager 0.01281 with negative revenue growth. This isn't a fundamentally strong company. It's a speculative play on an event. If that bidding war doesn't pan out or a deal falls through, those weak underlying fundamentals will be exposed and the stock could plummet. We rated WBD a stay away on December 9th, and honestly, the risk here is still far too high.
Purely an event-driven trade then, not an investment.
Precisely. The final verdict for WBD, stay away.
All right, Oracle, ORCL. Now, this one's fascinating. The analysts seem to be positive, with buy ratings and price targets significantly above its current level. We even saw some insider purchases. They're also making a big pivot into cloud and AI data centers, which is where the future is, right?
Ethan, the social media sentiment for ORCL is overwhelmingly bearish. Many users, after digging into the Q2 earnings, are calling them actually bad, claiming the EPS beat was heavily influenced by a one-time gain from an asset sale.
Speaking of Warner Bros. Discovery, WBD, the sentiment here is predominantly bullish, directly fueled by the anticipation of a bidding war. Users are literally saying, I don't care who wins, I just want them to keep bidding. The stock is trading near its 52-week high, and the news is just non-stop with Paramount, Skydance, and even political figures like Donald Trump weighing in. It's a very exciting time for WBD shareholders.
It sounds exciting, Ethan, but the KPIs tell a very different story when you strip away the acquisition buzz. WBD has an astronomically high PE of 155.42. That means its current price has absolutely no grounding in its current earnings. Its debt to equity is a very high 89.857, and its net profit margin is a meager 0.01281 with negative revenue growth. This isn't a fundamentally strong company. It's a speculative play on an event. If that bidding war doesn't pan out or a deal falls through, those weak underlying fundamentals will be exposed and the stock could plummet. We rated WBD a stay away on December 9th, and honestly, the risk here is still far too high.
Purely an event-driven trade then, not an investment.
Precisely. The final verdict for WBD, stay away.
All right, Oracle, ORCL. Now, this one's fascinating. The analysts seem to be positive, with buy ratings and price targets significantly above its current level. We even saw some insider purchases. They're also making a big pivot into cloud and AI data centers, which is where the future is, right?
Ethan, the social media sentiment for ORCL is overwhelmingly bearish. Many users, after digging into the Q2 earnings, are calling them actually bad, claiming the EPS beat was heavily influenced by a one-time gain from an asset sale. They're highlighting tanking free cash flow and an incredibly high debt-to-equity ratio of 452.534. That is an extreme level of financial leverage. While the AI pivot sounds good, users are skeptical, calling it a last-ditch effort given their shrinking core software business. Our last rating for ORCL was stay away on November 20th.
So despite the positive analyst takes, the community's deep dive into the numbers raises too many questions for you.
Absolutely. The financial risk from that debt, combined with concerns about the quality of earnings and the sustainability of their strategic shifts, makes it a very difficult proposition. The final verdict for ORCL? Stay away. Last but not least, OneStream, OS. Now, the community discussions seem to mix this up with Palantir in some posts, but looking at OneStream specifically, the news is quite positive. Rosenblatt initiated a buy rating, predicting 20% annual revenue growth and breakthroughs in AI. They're also a 5-time leader in Gartner's Magic Quadrant and have a strategic AI partnership with Microsoft. That's a very strong growth narrative right there. It certainly paints a compelling picture for future growth, Ethan. But let's bring it back to the KPIs. OneStream is currently unprofitable with a negative net profit margin and EPS, and their debt-to-equity ratio is still quite high at 3.144. While the growth potential and industry recognition are positives, an unprofitable company with that level of debt, especially after a significant drop from its 52-week high, carries substantial risk. We've never rated OS before, but the current financial picture is too precarious for me.
So despite the analyst praise and growth prospects, the current financials make it a no-go for you.
For now, yes, we need to see that strong revenue growth translate to a healthier bottom line. The final verdict for OS, stay away.
Well, Brooke, it sounds like today was a pretty clear message from our AI analysis and market commentary.
Indeed, Ethan. A lot of strong opinions, but the KPIs consistently flagged significant risks for all the companies we looked at today.
So for our listeners looking for where to focus their own due diligence, here's our compiled list from today's deep dive. Investigate as buy, none. Investigate as cautious buy, none. Investigate as speculative gamble, Warner Bros. Discovery Inc., WBD.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Do your homework. Thanks for joining us on the daily hunt for multi-baggers. We'll catch you next time.